We're going to go ahead and get started. My name is Tyler Braun. I'm the Director of Financial Planning with the Tranel Financial Group. I hope everyone is having a great day. One question we've been getting a lot about recently is the inauguration came. It was this wave of emotion, and now it's beyond. And everybody is asking the same question. What's next? What can we anticipate? What should we worry about? And it's an open-ended question, but really today is educational. This is a live webinar. So just as a reminder, at the bottom of the screen, if you have questions, I've got Jenna Bradford, the president of the Tranel Financial Group, on here as well in the background. So on the bottom of the screen, there's a chat tab there. You can go ahead and click that and type any questions that you have as we go through this webinar, and we'll do our best to answer all the questions as we go through. Today's webinar is strictly meant to be educational, right? So we're going to talk about some things that are hard for individuals to talk about lately, which is politics. And this is by no definition one way to vote or another. This is just talking about facts and statistics as we dive through from an educational standpoint. So I'm just putting that out there ahead of time. But with that being said, we always start every webinar with an agenda, right? And the things that we're going to cover the most here, excuse me, right? The first piece is just with change in volatility comes opportunity. And that's the theme that we continue to talk about is with change in volatility comes opportunity. I want you to have that in the back of your mind as we dive through these slides, because there's lots of change that's happening and there will be opportunity that comes from it. And that's a positive that we need to focus on. So first thing we look at is what's going on now. And we're going to go slide by slide with this, but the world is moving faster. They're talking about less regulation. What does that mean, right? We're going to touch on tariffs. We're going to talk about possible tax changes. I feel like we just talked about this, and we did, and now there's possible tax changes again. Interest rates and unemployment are extremely important, especially with what's going on in the economy today. And then, of course, there's opportunities that we need to touch about as well. So with that, let's get started here. So one of the comments that I'm hearing a lot is it just seems like the world is moving faster. And one of my mentors talks about all the time. He said the slowest the world is ever going to move is today. And it's crazy to think about, but I think that's very accurate. And if you're taking notes, you're going to want to write that down. The slowest the world is moving is today. It's only going to go faster. And if you look at the activity, one of the pieces that points to that and talks about change is the amount of executive orders that have been signed in the past week. So if we look at President Trump here and talking about moving faster and moving towards some change, right? This is historically the amount of executive orders that have been signed by presidents coming into their term. And this is on day one. So you can see back to 2001, George Bush signed 0 orders on his first day. In 2005, when he was reelected, he signed 0 orders. President Obama in 2009 signed 2 orders. In 2013, he signed 0 orders. President Trump in 2017, which was his first 4-year stint, signed 1 order. President Biden in 2021 signed 9 orders, which was historic at the time. Day one of the inauguration, right? So within an hour after the celebration, President Trump signed 26 orders into office. So think about that, 26 orders. So we are seeing a lot of change. You're hearing a lot of change, but just know the world is moving faster and faster, and we need to continue to be prepared to take advantage of that, which is very exciting. When we look at the different types of orders that were put into place, it really came down to 3 different measures. We saw 6 executive orders on immigration. We saw 3 executive orders on energy and environment. We saw 14 executive orders on forms of governmental change. Now, all of that being out there, and you hear that word change, really what it's coming down to is saying, okay, how do we put things into place? How do we take advantage of these changes that are out there, right? We're seeing forms of immigration that are changing. We've seen energy get changed. And really what they're talking about when you hear that term in energy, President Trump uses the word drill. He says, drill, baby, drill all the time, right? What he's talking about is reducing federal regulation across the board. So what is happening in the background is you've seen 78 executive orders that were in place by President Biden previously get rescinded. And what he's done is he started to roll back some of the regulation that's in place to allow future growth to take place. So one of the pieces that we're watching and continuing to track is energy production, right? So that's that drill baby drill term that he talks about. We've seen pipelines get opened up. We've seen different things get passed that weren't passed before. And that was in effort to reduce inflation. And that's something that's top of mind for everyone. Greenhouse gas emissions bills have also been rescinded. We've seen oil drilling also now. Some of the measures that President Biden put into place have been removed, and we've seen oil drilling start to tick up, right, in a short period of time. Less regulation from the federal government. We're going to talk about that here in a second. We've seen that to the extreme. And we're also seeing what they call the Department of Government Efficiency step in, or DOGE. Remember, the government is the largest employer in the US. And what they're looking at is saying, okay, if we start to run this more like a business and we trim some of the, overspending per se, will that cut into the deficit? And that's a big question, right? Will it cut into the deficit and reduce what we have, right? We have over $34 trillion in national deficit right now on our formal balance sheet, and it continues to get bigger and bigger and bigger, especially as interest rates continue to stay high. One of the largest line items we have on our budget every year is the amount of interest we're paying on that debt, and we need to start paying attention to that. So when we talk about regulation, right? Regulation is something that I think everyone on here can agree upon that we need to some capacity. So when you look at the definition, this is directly off of Morningstar.com. Reduced regulation is also known as a term called deregulation. What it's meant to do by deregulating is potentially stimulating the economic growth by reducing some of the compliance hurdles or costs in place. And I think everyone on here can think of an example where you're thinking, wow, yeah, there's been a time where, you either had to go through an HOA, or you had to go through a local government, or you had to get a permit to do something. I think of stories that clients tell me where they want to trim a tree that is scratching their car when they pull into their driveway, but they have to go get a permit just to trim the tree. Now, regulation is there to protect all, right? It's definitely needed. So I'm not sitting here saying we don't need regulation, but in the lower right-hand corner, what's very interesting about all of this is you can see dating back to 1950 how the amount of pages of published federal regulation is approaching 2 million pages of federal regulations, right? So by the end of 2024, it was supposed to eclipse 2 million pages of federal regulation. So you see the hockey stick here. What they're looking to do is roll that back. By rolling that back, it streamlines processes, which can allow for economic growth. That's their goal. Now, I will point out that anytime you deregulate, it can cause other issues. And that's where you see it can carry risk, whether it is for consumer protection, environmental damage, potential instability on certain sectors if you were to roll back regulations, right? You think of regulations being put in place. Think back to the housing market crash in 2007, 2008, right? Regulations needed to be put into place to protect against that. That's some instability that can form if you go to the extreme side. What we are seeing, though, is a large push to deregulate certain industries that were overly regulated to try and continue to stimulate growth in those areas in the short term. Once again, I'm going to come back to this. That does lead to various opportunities in those sectors. Next piece that we're going to touch on that everybody hears about in the news is tariffs. Okay. And I want you to think of tariffs, right? First, let's start with a definition. So a tariff, whether you want to call it a tariff or a tax, it's the same thing. So a tariff is a tax on imported or exported goods that a government imposes to raise revenue, right? So think about that. The government, if President Trump says we're going to apply a tariff on China on all imported goods for 10%, that's a 10% tax on any of the product that's imported into the United States coming from China. So whether the company that's importing the product to build out their widget or their machinery is swallowing that cost, or if they're handing it on to the consumer, is yet to be seen. But that 10% increase, right? That's a tax on that product that's being imported. So when you hear the word tariff, I want you to think of it. It is a form of taxation. Now, tariffs can be used to help protect domestic industry. So, for example, if another country is selling products at a fraction of the cost to what our American companies can do or manufacture that good, you can impose a tariff on that other country to make it an even playing field or an even cost. So the case study that we read about all the time is for washers and dryers. So there's the company of Whirlpool and there's the company of Kenmore, right? What we saw is one is an American-based company, one is imported from South Korea. South Korea's washing machines were drastically cheaper than those made in the United States. That's why you saw tariffs imposed back in 2007, 2018, and it actually increased the cost of those South Korean washers and dryers by 25%, which made it an even playing field and actually kept the American company in that study in business. So when we look at it, it can be used to protect domestic industry, but it can also be used as a negotiating tool. And that's what President Trump has used in the past is he's applied tariffs to different countries to negotiate different trade agreements that he feels are more suitable to benefit the United States. Now, the hard part behind that is, right, that is a lot of anxiety and change that can occur when a trade deal is being reached or achieved. What's different this time than what we saw back in 2018 and 2019 is the United States is actually looking at tariffs as a form of a way to generate additional tax revenue versus just a negotiating tool. So one of the terms you guys can look up when you have a chance is called universal tariffs. And that's something that is being explored right now is do they apply a universal tariff across the board for any imports coming into the United States? If there is an if there is a universal tariff that's applied, right? And historically, if you look back over our nation's history from the beginning of the United States to where we are currently, right? The average tariff we've seen during our nation's history has been 30%. So you think about that. The average tariff has been 30%. Right now, the average tariff the United States charges to other countries is 2%. So it's the lowest in our nation's history. Now, we got here because free trade opened up, which allowed our countries to trade into other countries. We were looking to accept goods into the United States and not having to pay a heavy tax to do so. We can buy a lot of product from other countries at a reduced cost, which makes our companies and our companies more profitable. But we also have to look at it as a way to say, are we able to sell to other countries with the same trade agreements? In certain instances, we're not, right? So when we look at the revenue, what they did is they actually created the external revenue service, right? So the IRS is the internal revenue service. They've created the external revenue service to look at how to manage the incoming revenue from the tariffs that will be generated. The fact that they've created that entity is a precursor that everyone on here should take note of. You don't create an external revenue service unless you're going to charge tariffs. So the tariffs have not yet been announced or discussed, but they will be there in the future because we've already created or President Trump has already signed an external revenue service office to be created. With that comes uncertainty. We're going to talk about some of that. Okay. That can disrupt, especially in the short term, the global supply chain if we get into a retaliatory tariff or a tick for tat tariff war, very similar to what we saw in 2018 with China. The biggest difference that nobody is talking about is the possibility, though, of tax breaks for creating products inside the US. And this is the wild card that I think that media on both sides of the fence is not discussing because nothing's been passed thus far. A reduction in taxes is a huge benefit to US corporations. So think about it. If there's less tax that's owed, that's an increase of revenue for corporation. If you have an increase of revenue for corporations, your profits go up. If you have higher profits over time, typically the share price of that stock increases as well. So if we look back to 2017 for the Jobs Tax Cuts Act that was passed, what we saw is we saw corporate rates drop from 35% down to 21%. It was a 40% reduction in taxes, right? We went from 35% as a corporate rate to 21%. Its time is one of the largest tax cuts in U.S. history. During 2018, after that was passed, we saw corporate profits rise by 44.3% on the nation's top 296 tax-paying corporations. So think about that. We saw a reduction in taxes. A year later, we saw a correlation of a 44% increase on average in profit margins on our top 296 corporations. What President Trump is proposing that the media is not talking about, okay, and this is both sides, right, is to reduce taxes from 21% to 15% if corporations make their product in the United States. That's a 28.5% reduction in corporate rates. It would be one of the cheapest, especially for we are what's called a developed nation. We have the largest GDP in the world, and we would have one of the most attractive tax rates in the world as well at a 15% corporate level. That is a huge benefit to corporations to generate product inside of the United States. So what they're doing is they're trying to make the United States more attractive to generate jobs here, as well as bring that product back here. Their goal is to bring, so let's use a company like Apple, for example, right? Apple's one of the most profitable companies in the world. They hold more cash than most nations do. That's how much cash they have on hand. When we look at a company like that, that imports a lot of its widgets and products from other nations, a reduction in corporate rates by 28% when you have that much capital is an absolutely huge savings. Now, I'm not saying that Apple is going to do that. I'm just using them as an example here, but it's an absolute huge savings, which leads to more revenue, which leads to more profit. More profit leads to more gains for that corporation. So it is something to take note of that corporations are being incentivized to bring jobs to the United States. Because of that reduction in taxes, we've seen already different institutions make announcements for future investments inside the United States to pass that product into the United States and then be dispersed to take advantage of those reduced taxes. So just be aware that that is out there as a piece that as we do see uncertainty from tariffs, they are looking to reduce taxes on those corporations to offset that and possibly even grow through that tariff conversation. Now, with that being said, we still need to be prepared the what if tariffs were to set in. So one of the major pieces that we've seen is an additional 10% tariff on China, and they would call that a universal tariff. That's one of the strokes of the pen that they were talking about making is what if we just applied another 10% tariff to China? You can see on my screen on the left-hand side here where my cursor is, this is the impact it would have on real GDP to the United States. This is directly from the Economic Institute. What we're looking at inside of here is you would see a reduction in real GDP with no retaliatory tariffs from China of about roughly 2.5 basis points. Okay, so what that means is if we were going to have a 1% gain for the year, the tariffs on a 10% tariff on China would impact our GDP by 2.5% in that example. Okay, if we see a retaliatory tariff from China, which everyone I think would be anticipating, you can see that it can have upwards of a 5 basis point reduction on real GDP before flatlining. China would be more negatively impacted than we would because they rely so heavily on what we import. There's what's called a trade imbalance we currently have in place with China, which means we are buying considerably more product from them than they are from us. So you can see it would have almost a 15 basis point reduction on China's real GDP. And if we were to put a retaliatory tariff on China, you can see it could have upwards of a 20 basis point reduction on their real GDP, meaning they would also feel quite a bit of pain in the short term if we were to get into a tick for tat tariff war with China. From an inflation standpoint, and this is something we've heard a lot of concern about, if we see tariffs, will it drive up inflation? That's a loaded question. What we saw in 2017 and 2018 is a lot of corporations shouldered the front end of the price increases until they felt they could no longer do it. Then they started to pass it along to consumers. You can see that if we did apply a 10% tariff to China, the United States would see just over a roughly 6 basis point increase in inflation. We would see inflation spike in the short term before leveling back out. If there's a retaliatory tariff from China, you could see we could have over a 10 basis point increase in inflation in the short term before reducing. But you also see China would deflate before inflating. You see how that is inverted. As the United States inflation went up, you see how China's went down. Everybody asks that question, why would China's inflation decrease? We buy the lion's share of the product they sell. If we're no longer purchasing that product, they have an abundance, an overabundance of product that nobody wants to purchase. So the value of that product comes down. That's deflationary. When they start to sell that product again, then inflation would spike up quickly because you would see fire sale. They'd be selling things at a reduced price to get them up. You would see inflation start to fire up pretty quickly inside of there. So China would actually see a deflationary event in the short term. Longer term, they would see inflation come from it. The United States would see inflation spike for the short term before settling out. The one that we've been hearing more and more about is Mexico and Canada. And this is a different piece to look at, right? This is a different agenda item than what Trump had talked about during 2007, 2018. It's what if we applied a 25% tariff on Canada and Mexico? And you can see this is, in my opinion, this is a business deal that is occurring right now because you can see from a real GDP standpoint how much of a negative impact this would have on Mexico and Canada. It does not impact the real GDP of the United States to the extent that it does the other two nations, right? We would be decreasing our real GDP by about 2 basis points overall. Canada would have a reduction in the short term, of closer to 15 basis points, and Mexico 20 basis points. So, if they had a GDP of increase of 1%, 20% of that would be gone in Mexico's example that we're looking at there. From an inflation standpoint, you can see the United States does not have a dramatic increase in inflation by applying that tariff. It goes up by a little under 5 basis points. Canada and Mexico would have a dramatic increase in inflation on those products. So from that standpoint, you can see Canada and Mexico from a tariff standpoint, if you're watching the news and you're hearing that Mexico or Canada is willing to work with Trump, this is why they're working with Trump and why you hear that on the news all the time. You can see Canada and Mexico very much so are reliant on the United States not applying that tariff as it would have a dramatic impact on their economy and it would spike inflation quite dramatically for them in the short term. I know we're covering a lot here, so once again, if you guys joined on late, please feel free at the bottom of the screen to just click the chat tab. If you have any questions as we go through here, because I know I'm covering a lot of data points, please feel free to click that, and then Jenna will be able to get those and reload those questions over to ourselves so we can get them answered. So, a look back, I want you guys to think back, put your thinking caps on here, think back to 2018, 2019. We saw a lot of volatility creep into the markets when the tariffs were announced the first time. And I know that, that was a long time ago. It was 5+ years ago at this point. But what's interesting about it is the phase one China deal is still in place. We still have tariffs out there against China that were never called back, and China still has tariffs against us currently that were never called back. But you can see the New York Times here and Reuters, some of the headlines that had occurred when we had announced those tariffs back in 2018 and 2019. And it created quite a bit of volatility in the short term. The reason I share that is you think about how much economic growth we've had since 2019. We always have to be thinking of the next. We have to be thinking of the future. There's always going to be disputes and tick for tat and conversations. We have to think of the long term and the profitability of corporations. If you're investing in a company that you use their product, you like their product, and they're profitable, they're probably going to be bigger 5 years from now than they are today because other people probably like their product as well. And we have to remember that, right? So we will see volatility that comes from tariffs. There's no question. It's not an if, but a when. And with that is going to come some tremendous opportunity, which we'll talk about. The next piece that I want to reference here is interest rates. If you're taking notes, this is what you want to write in bold capital letters: interest rates. This is what's caused in the last 6 months the most amount of volatility in the market right here. Okay. Do you remember back to December 11th of last year, and the Dow was down about 1,200 points in a day? And everybody said, whoa, Fed Chairman Powell came out in the afternoon and he said, we're going to decrease interest rates by 0.25%. And that was expected. And the markets reacted with a negative 1,200 point decrease. Everybody said, why did it go down when he did exactly what he said he was going to do? It's not what he did by cutting the interest rates 0.25%. It's what he said after that. And what he had said is in 2025, they were originally calling for anywhere from 4 to 6 rate cuts in 2025. So typically during a rate cut, you see about a 0.25% decrease. So that means they were looking to cut interest rates this year, 2025, anywhere from 1 to 1.5%. That's what they were referencing previous to December 11th. In that last discussion during December, he said they're only targeting 2 rate cuts in 2025. Well, that's a huge difference when the market had already been pricing in 4 to drop to 2. And that's where we saw the volatility occur from that because the market had to give back everything it had already priced in. So what I love about this is the blue line that you see on the screen here is the federal funds rate. And you can see the way that the Federal Reserve combats inflation is they raise interest rates, right? So inflation is a sign that the economy is overheating. And we saw inflation in 2021 and 2022 hit the highest level it had since the 1970s. We saw the CPI report, right, crest over 11% at one point, which is the highest it had been since the huge run up in the 1970s of inflation. So what the Federal Reserve does is by raising interest rates, it sounds backwards, they're making things more expensive, right? How does making things more expensive reduce inflation? It's all supply and demand. So if we are seeing inflation run rampant, home prices go up, car prices go up, etc. What they do is raise interest rates on those loans. By raising interest rates, what they're doing is they're forcing the consumer to pay more interest to purchase that same product. Same thing if you have revolving debt, you're paying more interest on your credit card. What that means is you have less cash flow left over to continue to purchase other goods at the same rate. And obviously, if your desire or demand to buy product comes down, there becomes a larger abundance of product available. If there's more product available, you see prices decrease, right? So it's all supply and demand driven. So the Federal Reserve from 2022 to 2024 raised interest rates at the fastest rate in US history. You see how it's a hockey stick straight up. Almost every single month, they raised interest rates anywhere from 0.25% to 0.5% to get where we were at our peak at just over 5.5 or 5.25% at an effective funds rate. You can see they started decreasing them towards the end of 2024. And those of you listening probably have heard of the term called a soft landing, right? What they were doing is saying, hey, we want to continue to cut rates. And then we're going to get to a point where we have to start sparking economic growth. We can always cut them further to get the economy to take off. And we want the what they would call inflation rate to be right around 2%. And we're getting close to that target. We're in the 2% range right now. The Federal Reserve wants a 2% right on the dot inflationary rate. So what they're doing in essence, when you see this, what Jerome Powell was saying is they want to leave a little bit of, um, you know, gunpowder on the sidelines per se. They don't want to use all their chips. So if they continued to cut rates like they were doing, it would continue to spark economic growth because things would get cheaper. But inflation has remained very persistent, and the Federal Reserve is also worried about short-term inflation from tariffs. Remember, tariffs are a form of tax. If all of a sudden there's a 10% tariff on all products imported, that means that that cost could get handed over to the consumer. And now you see a 10% price hike. That's an inflationary marker, right? If the Federal Reserve is cutting interest rates and inflation is going up, that's the exact opposite of what they want to have happening. Also, if we see the market start to become volatile because of tariffs and going down, the Federal Reserve can very quickly cut interest rates to spark economic growth. It's very difficult to raise them, especially if the market is decreasing. So what they're doing is they're slowing down that interest rate outlook to make sure inflation is going away. It's the most conservative approach to the outlook that they have. So just be aware of that piece. Long story short, I know that was a big nerdy answer going through there. We do anticipate interest rates to still stay relatively elevated in 2025, higher than originally anticipated. So key takeaways. Tariffs are going to create uncertainty, but with that uncertainty is going to become opportunity. Look at the markets today, right? What we saw is the tech sector had a large sell-off today, right? And that wasn't because of tariffs. That's because of just overall global, I would say global news, right? What they talked about with the tech sector today is that China is further along on the artificial intelligence race, which is creating volatility in the tech sector. The S&P is 33% tech at this point, which drives volatility in the broader indexes, which leads me into the next few points is just knowing what you're invested in. Because also, in addition to knowing how you're invested, is less regulation is coming, and that can be good and bad, right? So you have to know how you're invested because if we see less regulation, it can create opportunities faster in certain sectors. But we also have to be aware if there's any bubbles forming or anything that's forming on the horizon that we need to be aware of because of too much deregulation. We have to look at using assets differently to take advantage of the volatility, right? The market and the world is moving faster than ever before. The question we have to ask ourselves is how do we take advantage of that volatility to your advantage, right? How do we position ourselves to say, if we see volatility in the technology sector, how do we jump on some of that? What is the right price? If we see certain sectors that are struggling due to tariffs, but when we know they're going to be profitable 3 or 5 years in the future, how do we take advantage of those? And those are the conversations you need to continue to be having with either us or your advisor. And then insulate your cash flow through yield. A lot of pre-retirees, right? If you're 60 years old or you're 65 years old, a lot of clients are saying, well, how do we position ourselves to not have to worry about market volatility in retirement? The most underutilized strategy out there is looking at yield and dividends, right? There's companies out there called dividend aristocrats that have increased a dividend for 25 consecutive years, not just paid it, they increased it. So even during 07, 08, they increased it. Even during 2001, the tech sell-off, they increased it. You know, even during the first round of tariffs, they increased it. So it's an ever increasing dividend that you can pull that pays a dividend regardless of the share price, right? So it's the number of shares you own, not the share price. It can really insulate income for your benefit. So as we look through those, right, the biggest piece is you have to know and understand how you are investing for the future so you can take advantage of these things. So opportunities, keep it simple, right? You want to focus on companies that are profitable. If you have a profitable company that does not have a lot of debt on its balance sheet, interest rates have little impact on that corporation. If you look at, they call them small caps, smaller corporations. Historically, smaller corporations have outgrown large corporations, except for the last 10-year time period. And most people look at that and they say, well, why is that? Smaller corporations don't have the cash on hand nor the cash flow. They're reliant on debt, and interest rates have been elevated. They also struggle during times of regulation because it's harder to get through all of the regulatory tape and it's expensive, right? We could see some of that possibly reverse here as interest rates decrease. So these are things that we need to be aware of. But what we look at and focus on are profitable companies that you know and like that are going to be bigger 5 years in the future than they are today. Know what you're invested in, right? If interest rates are going up, bond prices are falling. If interest rates are coming down, right? If you see interest rates driving down, you see bond prices increasing, right? So that's an inverse relationship. That's a known relationship. We have to know what you're invested in. Certain sectors are going to get hit harder during tariffs than others. The other piece that have been urging clients is to track how much of the revenue from the corporations you're investing in is generated inside of the United States. If you get into a tick for tat retaliatory tariff war with another country and they apply, so let's say you're invested in a corporation that generates 40% of its cash flow from residents in China. If we get into a tick for tat tariff war with China and they apply a 20% tariff, that cash flow is going to be cut immediately, which means profits are going to be hit immediately inside of that corporation you're invested in. So we have to pay very close attention to that. We got to continue to reallocate for the future. Remember, in your 401k, you have your current holdings and you have your future contributions. Future contributions are money you have not yet uh, invested or saved, right? That's what you're going to do during your next pay cycle and your next pay cycle. So the assets that you currently have in your account, we can treat differently than those that you have not yet contributed, right? Those ones that you're going to be making contributions with, let's be a little more aggressive with those because if we do see a reduction, you're buying at a discount. The more shares you own over time, the bigger gains you see when the market goes the other way. So we have to reallocate for the now and for the future and just continue, right? Continue to look at these as opportunities, right? The world is moving faster than ever before. There's a lot of unknown. So continue to look for opportunities to say, how do I take advantage of this? Because 3 to 5 years from now, I want to make sure that we're positioned correctly to see this large growth, right? And then insulate your income, right? Know where your income's coming from, know that you're taken care of, and invest in good, solid companies that are profitable. So, as we had talked about before, just how to be successful, right? Know what you're invested in. Continue to focus on the longer term with the corporations that you have. There's going to be a lot of volatility that's going to occur over the next few months. Add to your accounts through a dollar cost averaging if you're able, right? So just like you're adding to your 401k, a lot of clients say, well, I've got this $100,000, right? Well, yes, we want to get it working, but nobody is perfect at timing the market. And if they tell you they are, they're lying to you. So what we do is you want a dollar cost average, add money over a period of time. If you have $100,000 to invest, add a little bit every month, maybe add a little bit every quarter, right? What you're doing is buying the ups and the downs of the market. That way you don't have to worry about timing it. If you're drawing income, look at the yield, look at ways to protect the income. Interest rates are still higher. And then you have to start separating what they call income now versus growth later. Where do we need to draw income from now? How do we position that? And then where are we focusing on growth? Because there's going to be opportunities for that as well. And then be in it for the long term, right? So with that being said here, I'm going to turn it over. Jenna, do we have any questions that came in from the group at all as we went through all that information?
Yes, we do. We have three questions to start. The first one says, I've been hearing a lot of speculation regarding a market crash in the near future. What are
Mhm.
your thoughts on this?
It's a great question. So, I mean, honestly, you think back, we've heard speculation for market crashes, every year since, 2021, right? Since the recovery
Right.
happened after the pandemic. So there could be, right? There's going to be volatility at some point. We already talked to that through. There could be a 10% sell-off. There could be a 20% sell-off. The economy overall, though, right now, even with all of this unknown out there, is still very strong and very resilient. So when we put those measurements in place, real GDP is expected to grow over 3% for the United States, which is right in line with the goals that they had in place. Even when they benchmark the tariffs against that, it's still above that 2% number from a growth standpoint for GDP. So the economy has been very resilient and very strong. But yeah, there's certain sectors that are, in my opinion, a little bit overvalued right now, and we just have to be aware of that as we go into this. But right now, the market, still from a macro level, still remains very healthy and very strong.
Awesome. Thank you for answering that. The next one I have is giving a reduction in corporate taxes for companies that produce products in the US is a good idea. Will the tariffs help when taking into consideration labor and material costs? The labor costs are a vast difference.
Well, the tariffs as a whole are put out there for two reasons. So that question is looking at it saying the reduction in taxes um, can make it a more even playing field for corporations inside the United States, but our labor expenses are vastly more expensive than other nations are. Absolutely, they are. And the regulation here is much more than other countries as well. So what they're looking at is the reduction in taxes. That's a 28% reduction. It makes it more attractive to invest. There's certain sectors that it's just not going to make sense. Anything with manual labor as a whole is going to be very difficult. A lot of the investments that are being attracted are more of the automated, where it can be done more so. And I know that they talk about manufacturing jobs coming back to the United States and so forth.
Right.
There's some
Mhm.
of that, but it's a lot of white collar or it's a lot of automated where it's more parts being manufactured here. And they're, a job that's coming in where it's more of your robotics that are creating a lot of the product. There will be jobs with that, but I don't think it's going to be the numbers that they're anticipating. There'll be revenue that comes from it, but it's very hard for the United States to compete with other nations from a pricing standpoint, especially in some of these nations that, they do not necessarily pay their employees any type of healthy living. And I think you all understand what I'm saying there.
Right, right. Okay. Then that's a good answer. Thank you. The next question is, are the companies that have raised their dividends more risky? This was in
No.
relation to the last thing you talked about.
No, no. I was actually the inverse. So they're what are called value stocks. So value stocks are a value add to consumers. That's why they pay a dividend. So don't internalize the dividend being paid with risk. Typically, they're more of I always joke around with clients, they're a little more boring from an investment standpoint. They're going to grow and appreciate over time. And if you're a sports fan like I am, you're going to hit singles and doubles all day long with those companies. But what they're doing is they're paying out a consistent dividend or income stream, right? That's a value add to consumers. So rather than reinvesting their profits back into research and development or the company to try and grow the stock price higher, they're paying out a dividend in return and they're saying that we want to give that to the consumer. So it actually makes it a little bit more of a stable investment overall on the volatility metric. We measure that through a term called beta, and typically the beta is considerably less than what the overall market is. So it's less aggressive than the market, but still pays a really attractive dividend and can grow over time.
Okay, that makes sense, definitely. Thank you, Tyler.
Absolutely.
The next one that just came in, it says, excuse me, does lowering corporate tax increase tax on the lower middle class to make up the difference, or will the increased production level that out? Hmm.
It's a little bit of both. I don't see it increasing taxes on the lower and middle class, right? What it does is it increases revenue. That revenue, should get passed down, and that's the hard part. In the United States, there is greed that can come into the conversation, and we've seen that through various case studies over time as well, where they talk about the trickle down effect, and that does not always work, right? That's me being
Right,
completely transparent. That does not always work. But what it does is the growth piece, if you're showing more profits, right, those profits are then, still getting taxed, whether it's through a dividend to shareholders or whether it's through reinvestment for future growth, for future revenue. So we would see, right, we would see a reduction in the short term of tax revenue, But the growth that we see from a GDP standpoint, when you measure that, same thing for back to 2018 when you were looking at different case studies there, the growth did outpace that. So, if we saw a reduction long term in taxation and didn't have growth, that would be a real problem, right? And that's something that they have to have growth. Hence, they're trying to reduce taxes. By reducing taxes, they're saying we're giving you more revenue to reinvest and grow. If they reinvest in growth, the growth should be there. But if they're not getting the growth that's there, then it would be just a pure reduction in taxes. But I don't see that trickling down to an increase in, our standard or marginal tax brackets. I see that the Trump tax cuts from 2017 will most likely be passed and we'll continue with the rates that we have now.
Okay. Okay, that makes sense. Thank you. The next one that came in was, do you have any speculation as to what will happen to SSI? Do you see it going away?
No, I don't. I don't see it going away. I do think it might get taxed differently. I mean, one of the things they're talking about is no longer
Really?
taxing. They're talking about no longer taxing Social Security.
Hmm.
We already did pay taxes on it once, but um, if they didn't tax Social Security as a whole, right, that would be a huge savings to the middle class. Right? Think about that. If you're married and you're
Right.
both getting, let's say, $30,000 a year in Social Security, that's $60,000. If you're in a 20% tax bracket, that saves you $12,000 in taxes, right? That's a huge savings to people's pocketbook if they do not tax Social Security. Um, I don't see it going away. So two pieces behind this. Right now, the largest generation in the world, right, is the millennials. Okay, so you think about that. It was the baby boomers, but the baby boomers have continued to age and they're starting to pass away. And the millennials are the children of the baby boomers, and they're now the largest generation. The millennials are fully in the workforce at this point, meaning that they're of the age demographic that are fully paying into Social Security. So what happened before is the baby boomers were the largest demographic. Social Security was at a surplus because as the baby boomers were aging, they were overfunding Social Security because there were so many working paying into the system. But as the largest demographic retired, they were the largest drain on the Social Security because there was no generation filling the bucket back up. Millennials are now the largest generation filling the bucket back up as the baby boomers are passing away and aging. So we will get to a tipping point where it can be sufficient. The issue is, are we going to run out of assets before we get to that tipping point? I don't see any politician getting rid of Social Security because it would be political suicide for them. So I don't see Social Security going away. I do think you're going to see the age bands continue to get pushed out longer and longer, meaning that the full retirement age right now for the average American is age 67. I think in a few years it'll probably be age 70 across the board. They still want you to take it at 62. That's the early retirement age. So I think that will still be there, but I do think the age bands will change to make it more sufficient for people going forward, but I don't think it'll go away. And now I don't have a crystal ball, but that's just the studies we're seeing.
Okay. There's a follow-up question to that that says the income from that definitely helps fund the system. What would they do instead?
If they
Correct.
didn't
Yeah.
tax Social Security,
Hmm.
does it fund the system, right? Because that's ordinary
Fair.
income
That's a fair
tax.
response.
So what's happening is it's ordinary income tax on your Social Security that goes to the Federal Reserve and the federal, or not the Federal Reserve, but that's federal taxation, right? Your income that's withheld, right? The 6.3% from your paycheck, and then you have the employer side of that as well that pays another 6.3%. That's what's funding the Social Security system. That's what goes to Social Security. I do think you're going to see, and I think you should see an increase in that threshold, right? If they continue to push that higher, right now, I believe it's the first like 167,000 a person makes has Social Security withheld from it. Anything above that, there's no longer a Social Security tax. That's why a lot of higher income earners will get taxed heavier the first portion of their year. They get above that threshold, they no longer have that taxation. And cash flow feels a little bit easier for them at that point. I do think that'll most likely increase, and that will bring more funds into the Social Security system as well. Um, but I don't know if they're even going to tax Social Security or not tax Social Security. That's just one of the things that's being floated out there right now, Jenna.
Okay. Awesome. Awesome. Well, thank you, Tyler. I don't have any further questions. Someone just made a comment that says, DeepSeek News Today highlights your comment regarding the pace of change. Thank you for offering the webinar as well. So
Absolutely.
thank you, Tyler. You did a great job.
We appreciate all of you. If you have any questions, please feel free to reach out to our team here. We're happy to help. That's what we're here for. Hope all of you have a great rest of your day. Take care.